Hello everybody. So, have you generated tremendous income through your equity investments over the last 1 year? Practically whichever stock you were identifying or investing has generated 20%, 30%, 50% or even 100% returns during this phase. But do you think currently identifying such potential stocks is slowly becoming difficult? What do you do now? Move to mutual funds? They might not generate as much returns as direct equities. Move to insurance? They might not be pure investment products. So what are the options left with you? Start watching news? Start following Telegram channels? Or start following certain articles? Now at this point, the fashion at which the markets were operating last year might not happen the same way. So at this juncture, don't you think so? Understanding the depth of the market is necessary? Please watch the video till the end. Welcome back. My name is Sumit Chanda and a grand welcome on the first episode of Market Miles. Now we need to answer a really important question. Why is the market behaving in this manner while it performed so well while the entire country's financial condition and economy was struggling? Now we need to consider a couple of points. Let's start with the current market situation. So if we look at Sensex, Nifty, it's practically making new highs every single month. However, post the second wave of COVID, the GDP of the country has contracted to 7.3%, while we are seeing that Nifty is almost 17,500 and Sensex is closer to 60,000. But if you look at large cap as a pool, it has contracted by almost 47%. If you look at mid cap as a pool, it has contracted by 11%. And if you look at small cap as a pool, it has contracted by 44% from its lifetime high. Now, obviously, there were several reasons behind it. Lockdown being the biggest, followed by a lot of businesses which got negatively impacted, followed by unemployment because of the entire lockdown situation. Lastly, a decline in domestic consumption. Second point being inflation. Now, inflation is being hovering over us for quite some time. If you look at RBI's inflation target for the country, which was anywhere between 2% to 6%, but post second wave of COVID, it has already exceeded 6%. If you look at the commodity prices, be it crude oil, steel, iron, everything is off the roof simply because of higher industrial growth and demand. Now, government is also heavily relying on revenue from excise duty and VAT of petroleum products. Now, all of these components will eventually push the production cost for all the goods, and which will directly have an impact on the end consumer. Now, government has also come out with a lot of triggers in the form of policies, starting with the national monetization policy, abolishing retro taxes, or even declaring relief packages during your budget 21. Now, an important point here is to note that while the markets are not growing as rapidly as last year, but it is also not correcting. We are somewhere in the drifting phase. Now, in technical terms, this is called consolidation. The current consolidation is very much evident if you look at the current markets. The markets are making highs followed by a couple of days of correction. Again, it's making a new high and the pattern is repeating. Now, many experts feel that investors should stay away from the markets while it's in a consolidation phase, simply because you don't know which stock is going to perform and which is not. The economy is recovering, but it might take slightly a longer period of time to get to a fully recovered stage. Till that time, what do? There are strategies which you can implement to make a successful investment portfolio even in these markets. Now, building your portfolio even in this scenario against all the odds, obviously you need to have certain principles that needs to be followed. Number one is follow a diversification strategy. Now, over the last 1 year, you might have been heavier on either IT or pharma or chemicals, or it can be any other sector for all it matters. But then going ahead, this strategy might not give you equal results. So having a diversified portfolio into different sectors, different themes would definitely help you create a stable portfolio. Second would be I would say stop timing the market. Now, we look at Sensex and Nifty's merely 30 stocks of Sensex and 50 stocks of Nifty, and we kind of judge the market. But then if you look at it between both the bourses, BSE and NSE, there are over 5,000 listed stocks. Now, the situation for all the stocks is not exactly reflected by a Nifty or a Sensex. So there are many opportunities available in the market even today. So we need to explore those opportunities. Number 3 would be do your own research. So whichever script, whichever stock you feel that you want to enter, have a proper understanding of where you are entering, what is that you're looking into that particular company, that you want to invest into that company. Then I would say whenever you zero down on whichever stock you want to invest, stay up to date with the news and updates and the corporate actions of that particular stock. A classic example, a couple of months back you would have seen DHFL got delisted. Now many investors would have had DHFL in their portfolio even after it got delisted. It's merely a matter that one needs to follow the news, what's happening with the companies that the person has invested into. So you need to, 1, do a proper research, 2, need to follow updates and news about that particular company. 4th would be not to do bulk investments. Now you would have allocated whatever amount of your money into for equities, but then not to pump in all the money at a single go. It's always better in these kind of markets to do a rupee cost averaging. So whichever stock you identify, you look at it and you start picking it up in periodic intervals. So it can be monthly, it can be maybe weekly, or it can be bi-monthly. So whatever is the choice, but avoid buying in bulk. Last would be stay at margins, not to be over leveraged or even leveraged for that matter. Now in this scenario, for all you know is you enter into a particular stock and all of a sudden it goes for a minor correction, and everything, your calculation at your end goes for a toss. So avoid leverage as much as possible, stay at your margins. Now, why do we need to follow all these steps? Now, we all feel that there's a silent economic killer between us, and which is COVID. But the actual culprit is not COVID, but the correlation between the macro parameters and the capital market performance. Now, this disconnect between the macro aggregates and the capital market performance has actually paved way for another serious risk for the country, which is R, that is return on legacy wealth, which is slowly getting greater than G, that is growth in per capita income. Now let me explain you with an example. Now let's all assume that there's a huge company having a lot of fixed asset, a lot of manufacturing units, producing something, manufacturing something, selling something, and obviously behind this entire thing there's a workforce which is enabling this production, manufacturing and sales. Now there's an amount of revenue that this organization is generating at the end of the year. Certain part of it is being retained as profits, certain part of it is reinvested in the business, and probably certain part of it is being passed on to this workforce. Now whenever the distribution is equal, the economy remains stable, but whenever this distribution is unequal, that actually gives way to a situation where the R is greater than G, which is the growth in the legacy wealth is higher than the growth per capita income. It's absolutely normal for a developed country, but for a country like India having a very good growth in the population, the growth per capita income ideally should be higher than the growth on the legacy wealth. Now this situation is more like a phase. Therefore, for India not to get into R greater than G phase, we need to undergo some major changes and on a consistent basis. So as I said earlier, consolidation is here to stay with us for quite some time, unless it either heads towards a breakout or a correction. But then, as I mentioned earlier, certain strategies to create portfolios and maintain them. Similarly, there are certain principles we should follow while doing individual stock picking. So you start with look at profitable companies and less risky companies. Now the worst thing that can happen now is getting caught in false breakouts. So to avoid that, second would be do a thorough volume analysis in which stock you're entering into. Look at the advance decline ratio on a daily basis, on a consistent basis in fact, before getting onto the decision of investing into that particular stock. do a value analysis. So just don't look at what's the volume the company is doing or what's the stock price the company is doing and how many people are actually trading it. So basically do a volume analysis and a value analysis, wherein you look at what's the quantum that is being traded. So you get a value of that particular day when you multiply the stock price of a particular day into the volume of that particular day. So do a value analysis. Sometimes it might happen that expensive stocks have comparatively less volume, but penny stocks have got huge volumes. So that's not to get into these kind of situations wherein you end up entering into a high volume company, but probably it was a penny stock. So for avoiding that, do a value analysis as well. Look at companies preferably which are debt free or almost nearing to getting off with their debts. So there at least you will be safe. Look at low momentum stocks and especially look at the alpha and the beta that the stock has. How well it is able to beat the benchmark, how well it is able to outperform its peers. And also look at the beta of the stock. Look at the correlation between the benchmark and the stock. Look at how well it is able to do during volatile market situations. Now, as I also said about portfolios, which is do rupee cost averaging. Similarly, even for a stock, even if you decide to enter a particular stock rather than a portfolio, please do averaging and don't buy everything at one go. Try to create your portfolio majorly, so roughly about 70% between NSE 200 stocks, and the balance 30% you can practically invest across smaller mid caps and small caps. Now a lot would also depend upon the following two quarterly results also. And lastly, if I have to talk about certain sectors which you should be looking at, I would say definitely IT, but then I would say avoid looking at the large cap stocks in IT. Look at the mid cap stocks, look at the small cap stocks within IT. The amount of performance they can deliver can be humongous. Second would be hospitality. So a lot of these food and beverages, hotel stocks, gaming stocks, tourism stocks might be some game changer in the coming time. Although we have the third phase hovering over us, but then still let's be optimistic and let's hope that things open up so that that helps these stocks to grow. Third would be alternate energy. Now everybody is actually talking about that today. So you can look at EV, you can look at companies into battery manufacturing, you can look at service providers. So these are some of the sectors which probably will give you better returns than maybe other industries in the coming some time. And last thing I would say is always keep a longer horizon when you are investing into and not a shorter horizon, especially in these kind of markets. Now that's it from my side today. Thank you for watching, and please do like, it will give us a lot of encouragement, and please add your comments. In case you want us to make any specific videos on any specific topics, please mention in the comments.